What is going on? Johnny Lynham here from JohnnyLynham.com, and we're back with another video talking about the 21 irrefutable laws of real estate investment. If you are a real estate investor and you're ready to scale, you're looking to do more deals, now we start cutting rates, tune into this video. You will not be disappointed. So right now, we're going to just jump straight into it, and we're going to go right into number one. And we're going through, you can find these articles on my blog, on my website. You can also check them out on biggerpockets.com. We share a lot of content out there, and we are all about helping educate people on real estate investing and sharing my story about how I've used these same strategies to change my life, and you can do the same thing. But with that, we're going to jump into number one, the law of location. Location, location, location. That is extremely important when you look at it, that areas that are in hot markets, they appreciate 10 to 20% faster over time. So you want to look for neighborhoods that have good job growth, they have really good schools, and they have different amenities like they have a Starbucks, they have Publix, Harris Teeter, or they have a fine dining, they got breweries, pubs, things that attract people that want to live in those areas. And the thing is, when you start looking at the data, homes with areas with strong infrastructure development saw annual appreciation of 7% in 2023, well above the national average of 3 to 4%. If you own real estate in 2020 and you still own it now, you've done really good. You probably got at least 30% to 40%, depending on what area you are, of appreciation over the last 4 years, just with everything, with all the money that was printed, the stimulus checks during COVID, and now where we are with the run up inflation, like housing prices are still going up because guess what? There's not enough inventory, supply and demand. So you want to make sure, number one, you're in a great location. Number two, the law of cash flow. So this is the second one, that you want to focus on your cash flow, cash flow, cash flow. One of my sayings that I have: if it doesn't cash flow, let it go. So the big thing is, I tell people, they get caught up, oh, interest rates are too high. No, you buy cheaper. Make sure it cash flows from day one. And when rates go back down, guess what? You can refinance and it's going to cash flow even more. But the biggest thing is, you want to make sure you do your analysis and you factor in your mortgage payment, but also property taxes, insurance, and maintenance. Maintenance, maintenance, maintenance. And one of the things that a lot of people don't do, I pay 10%, 10% in there to pay my property managers, because guess what? I am focused on my next investment and not really the day to day. I turn it over for 10% to a property manager so I can focus on growing and not on the tactical side of the day-to-day management of the house. For some people, if that's your retirement plan, you can do it. But for me, I'm always looking at property management and focus on the next deal, because if I can find another deal to make me 30 or 40K, why am I trying to collect rent and save $200 a month or $100 a month? You figure out what works best for you. Number three, the law of leverage. And this is one of the great things about real estate is leverage, 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 leverage. Because think about it, with my veterans, 100% financing, you can go buy a $600,000 house with no money down. That is leverage. 100% financing, you got zero money invested in, and you can control a $600,000 asset. You have a loan for that 600K. And so that's the thing, when you start looking at it, when you put 20% down on a property that you own 100% of, guess what? Now you're able to leverage money from the bank. You don't have to save up $600,000 to go buy that property. Now you only have to save up zero for my veterans, or only 3.5% down payment for those using like a FHA loan product. So that's one of the great benefits of real estate, is the ability to leverage with debt, with different lenders, to go through and make sure that you're getting the deals done. And so that's the thing that I love about it, because now you're able to take that leverage and build wealth when you're able to find assets that need value, they need appreciation, because they have low maintenance, they haven't been keeping up with the renovations. This is an opportunity where you can buy low, improve, make the renovations, force appreciation, and now you have more equity. Speaking of appreciation, that goes to our fourth law, and that goes into the law of appreciation. I love this one. I call it the icing on the cake. The cake is being the cash flow, and now you just got the icing. Is really cool. We'll call that the taxes, but really, when you think about the appreciation, we don't bank on it, but appreciation is the cherry on top. it makes it that much better. And focus on the cash flow, but the appreciation long term is how you build wealth. Because guess what? 10 years from now, guess what? Do you think rents are going to be higher or lower? If you're bullish on real estate investing and you think it's going to be higher, you need to be buying property today. And whatever the price is, figure out how to get in deals creatively today, because 10 years from now, 20 years from now, rent's going to be higher. Because guess what? The Federal Reserve said they want inflation to stay at 2%. 2% times 10 over 10 years, that means the dollar is going to be worth 20% less in 10 years. That's what they want to see happen. We know inflation shot up higher the last few years, and with the purchasing power of the dollar eroded a lot faster. That's why we love real estate. It's a perfect hedge against inflation. Because you think about it, we had all this inflation, and property prices have continued to go up. Real estate is a great hedge for inflation, and that's how you get that appreciation and you hold your assets, because guess what? It takes more of those dollars that's losing value to buy your asset, your thing, your home. And so now the law of property management, I talked about this a little bit already, that you got to get in there. You got to have the right property management. I focus on the team aspect of it. I used to try to manage everything. Well, actually, I take that back. My first property that I rented, we used a property management company. They only last for one tenant because the tenant moved out the next year, got a new property management company to take it over. I was out of town in Warner Robins, Georgia, my first duty station. I was living in Newport News at the time. And the other tenant stayed in there for the next 12 years until we sold the property. And so that's the thing, that just having the right property management in place and leveraging a team. Like all my 5 apartment complexes, I have property management that takes care of those. I live 14 hours away from Panama City, 11 hours from Montgomery, Alabama. And I have third-party property management that manages all of those things. I get involved for different things. We're doing a value add, working with the contractors, the leasing strategy, the business side of it. But like with my property in Panama City that stabilized, they text me like, "Hey, we do inspection reports. You can go in the portal and check it out inside Appfolio. Let us know if you want to increase rents." That's one thing that I had to press them on, because I talked to another investor. He's like, "Yeah, they're a good company, but they don't like raising rents." And I went and looked. I'm like, "Man, hold on. We're $150 behind everybody else in rents." And so we raised our rents up halfway. It's like, okay, if everybody else is getting 1,050, let us come in. We're gonna raise and get $1,000, and and it worked. And we tested the market when we had a unit available, and lo and behold, in less than 2 weeks, we had somebody put a deposit down. I was like, okay, boom, let's go, and keep moving. But having property management, they are a godsend, because I have personally managed properties before. My first 18 unit, I managed the first 6 months, and the best day of my life, those that's been following me, my story. The best days of my life is when I handed the keys over for those 18 units to the property management company, and I left Panama City and came here to the DC area. And the rest is history, because it's a strain. Like the stories and the relationships, people feel like they know you. And it's not to direct and go in a deep rabbit hole with this, but it was amazing, how everybody magically could start paying their rent on time when they had to pay the property management company versus having to pay me. And just having that professional business side of it, they have attorneys on deck that can step in, litigation, evictions. You don't have to worry about this stuff. They have a team to take care of it, and it allows you to just continue growing your portfolio. So now the law of market timing. Market timing. This is an important one, because you can't time the market. Nobody knows what the market is going to do, but you got to hedge your risk and make sure you're protected in case of downturns, because downturns happen. And so this is the thing that you need to realize, is making sure you have a good strategy when you're going into your deals, to where is that if the market timing, that now you can look for opportunities. Like right now, interest rates are starting to scale back. The Federal Reserve just dropped the federal funds rate by 50 basis points. Everybody's like, "Oh, real estate, real estate, real estate again now." And so that's the thing. We're about to refinance our 84 units in Montgomery, and it's perfect timing. I'm loving the timing. But the thing is, like, you got to be able to look at the downturn and see what's going on. And when blood's in the street is the time to buy. When people are scared and fearful, you need to be looking to buy assets. This is that time. Find the right assets and continue to move forward in building wealth. Number 7, the law of due diligence. Due diligence is so important, because so many people, they make mistakes during due diligence, and it hurts the performance of their asset. Because guess what? Now they're finding issues with the plumbing, the roof, the HVACs, that they did the water heaters because they didn't do the due diligence up front. And now they're having surprises. And now it's costing them time and money to go in and fix these things. So whenever you get a property under contract, get a property inspection report. Make sure that you're checking everything out. Make sure you have the right specialist to do your research up front. So now you can negotiate with the seller and they can give you concessions. They can fix things. I'll talk about my 18 unit that, the seller had to pay $31,000 to reroute all the water lines to the 18 units because there was a water main leak. And so being able to go through the inspection report and identify those things, it saves you money in the long term. And you can also ask for concessions for deferred maintenance where they haven't kept up the property up to par over time. And so doing your due diligence will save you a lot of money and headache and make sure that you're only doing great deals. Now, going to the law of diversification, number 8. So make sure you guys, if you're loving this video, hit the thumbs up, hit the subscribe button, and hit the little bell so you can always get notified when I share content. And so that's one of the things when we're looking at number 8. When we're going into the law of diversification, diversification is huge because it allows you to lower your risk profile. And like a lot of people, I'm bullish on real estate, but guess what? You should probably have some money invested in stocks. You should probably look at, hey, can you invest in your own self in a small business? Looking at, hey, should I invest in bonds? Should I invest in alternative investments such as a syndication, or looking to find something that's not correlated with real estate that I can invest in? And so maybe it's looking at a tech company or something with AI. Now you have your money diversified in different assets, whereas that if one has an impact, then now you're able to kind of skate through and keep your portfolio going where you're not overexposed to risk in one area. And so that's what I really love about diversification, because it allows you to not put all your eggs in one basket, and it allows you to reduce your risk. One of the big things that we talked about, the opportunity that I found when I bought my first apartment complex, was the 18 unit. It had hurricane damage. So it was like, I looked at that. It's like, you know what? I seen complete investors wiped out, especially like they had multiple trailer parks and stuff that didn't have insurance on them. Complete investors wiped out because all their assets was in one area, and you had a huge Category 5 hurricane come through, and now they were devastated. And so that's one of the things that we look at with diversifying geographically with our real estate. But then also the insurance, the expenses are a lot cheaper the further you get away from the coast. But then you can also diversify different asset classes, self-storage, apartment complexes, single families. You can look at doing fix and flip strategy, long-term holds. You can do an Airbnb, vacation rentals. So you have different ways that you can diversify across real estate. And then even you bring it up a level into different asset classes, which are stocks and bonds, your 401k, lending, selling notes, being a private money lender. You have a lot of different ways that you can grow your network and invest outside of just only real estate. Diversification is your friend long term. Tax benefits, number 9. We're rolling right along through the 21 irrefutable laws of real estate, and going into number 9, the law of tax benefits. Like taxes, it's not about what you make, it's about what you keep. Uncle Sam wants to help you if you're a real estate investor. And one of the great benefits, talk to your CPA. I'm not a CPA, but one of the great benefits of real estate investing is depreciation. And for those that buy apartment complexes like myself, bonus depreciation the last few years has been a game changer for us, especially if you have the real estate professional designation. For those that don't know, either you or your spouse can be a real estate professional and allow you to take that designation. It allows you to take that depreciation loss from real estate and apply it to any active income that you're making with your regular W-2 job. And so on average, real estate investors say 20 to 30% on taxes. And it is a great thing. And this is how you build wealth. But think about it. If you make $100,000 a year, if you're able to keep 20 to 30% of your tax bill, say if you were 32%, you're paying 32,000 in taxes, you're able to cut 30% of that, you're able to save $10,000. Over a decade, you've been able to save $100,000 that you can invest and build wealth on it. So that's the power of tax benefits. Real estate is great when it comes to being able to write off expenses for your taxes, depreciation, mortgage interest, any expenses with maintenance that you're doing. You can write all this stuff of travel, for trips, to go visit the properties, all of that, tax benefits. Number 10, the law of financing. This is one where we talk about that goes hand in hand with leverage, and it's the law of financing. And it just talks about being able to shop around. Don't take the first mortgage that you get. Shop around, get multiple estimates. Just like with contractors, we want people bidding for our work. We want people to put their best effort forward on how to get our earn our business. And that's the thing that you want to look at over time, like this one, interest rates. When you look at financing option, a 1% difference in interest rates on a $400,000 mortgage can save you $80,000 over 30 years. Something a little small like that makes a big difference long term. The law of finance, you want to make sure that you're looking at your financing options and comparing from different lenders. The law of the long term strategy, buy and hold, long term is where you build wealth. You're able to take advantage of the cash flow, the tax advantages, the long term appreciation, and you build wealth long term this way. And you're able to market dips. And so that's one of the things when you look at real estate investors, like long term, you're seeing that incline like this and just goes up. But you see little when you zoom in for like year to year, you may see some little perturbations, but eventually a long term is going up. And that's no different. That's what the long term strategy is. We're in this for the long term to build generational wealth. Forced equity. I love forced equity. Forced equity is a game changer because it allows you to build equity in a short amount of time. Buy low, refinance high. Well, a perfect example, our 18 unit we bought in 2020, we bought it, renovated 4 units that were still down, improved the rents when people moved out. We increased the rents, and lo and behold, in 2 years, we bought it for $1,050,000. In year two, the appraised value was 1.76 million when we refinanced. Pulled out 300,000. Guess what? Over the next year and a half, went and bought 4 more apartment complexes in Alabama. That is how you take equity and then you reinvest it into future deals. And guess what? Those were value add apartments. We're about to refinance those apartments now and pull out even more property and great cash flow because we're owning long term. And we had the appreciation, we had the cash flow, and we had the tax benefits, and it all rolls in together. Law of forced equity. Number 13, the law of market research. You have to do your research. You have to do your research and make sure that you have a good deal. And so that's one of the things looking at. You got to be a detective. You got to get under the hood, under the covers, and go. Because guess what? You would never go and buy just the thing. When you look at if you go buy a used car, you're gonna do your research before you go and look. Hey, how's this on maintenance? How's it holding up long term? And the same thing happens with real estate. You want to research the area. How's crime? How's the job market? What's the population growth in the future? All this is free data that's out there. What future infrastructure projects are they building? And so that's the thing that you want to look at. Quick hack cities that have a 2% plus annual population growth are usually solid bets because guess what? People are moving there. There's jobs to grow. And so the markets are getting hotter. So you want to look for some emerging trends. One hack that you can look at is emerging trend. Look to invest in areas where they're building new schools. New schools. Look out the new schools because those are areas where they know they got to have people to go to those schools. And if they're building a new school, they already know there's growth coming, there's population coming, there's jobs there. So look out for the new schools. And so that's a great one that you can look at. Risk management. We talked a little bit about this one, but the law of risk management is really focused on being able to manage that risk. You want to be able to have some cash reserves set aside in case something happens, anywhere from 3 to 6 months, to be able with roof leaks. When you do your inspection report, you're going to know the age of those major systems, so you know how soon you should roughly how it will last. And so you want to have those reserves at least 6 months, and you're going to be able to go through and ride out a downturn with that. So you want to have some money set aside for a rainy day with real estate because things happen. Tenants tear up your properties, and the last thing you want to do is to be in a position where you can't weather the storm when something comes up. Because guess what? You can't eat equity. The law of negotiation. This is powerful. This is powerful because being able to build relationships and negotiate with motivated sellers has changed my life. And going through and understanding the price, the terms, the closing costs, putting that together, working with lenders and being able to negotiate terms, working with your investors on how to pay them and the frequency and stuff like that. That negotiation is a no-brainer that you have to have in your repertoire as an investor to get deals done. So the law of exit strategy, like this is where you get the rubber meets the road. Like my good investors, the ones that smart, they get in, they have multiple exit strategies We know how to get deals done. We can do seller financing. We can do, cash out refis. We can work with a traditional lender. We can work with a private equity fund. We can work with private investors to bring the deal together to maybe some short-term debt, or we can give up equity in the deal. You have so many ways to bring the deals together with the exit strategies that you have to take advantage of. But if you don't have the information, you're not going to make it happen. And that's the thing that you got to realize is you got to get the information, because having multiple exit strategies is going to make you be able to get more deals across the finish line long term. The law of scalability: once you do one deal, it's time to go. Let's supercharge this thing and take it to the next level. The law of 17, the law of scalability. You want to be able to scale long term. Where do you stop? Only you can decide that. For me, I don't never have to buy another piece of real estate. We're good. With the level of our portfolio, the passive income that's coming in, once we do this refinance, we're taking rates down from 8% for the seller financing portion of it. And hopefully we roll something in sub 6% or less is going to be all good. And for our bridge loan we had on a 40 unit, it was at like 9.25. We're going to do another bridge loan for like 2 months and do a package one-time refinance in the conventional debt. And yeah, it is going to be a great day. And we're going to be somewhere close to around, at the expenses each month, we're going to be somewhere around 20, 22, $23,000 of passive cash flow after paying off all the expenses each month, including the mortgage for each one of these apartment complexes. The cash flow each month coming in is going to be over $20,000. And yeah, that's what we do with these deals. And so that's where we want to look at scale. But you don't need all that. I talked about in a video before about how a veteran client of mine, he bought a 4 unit with no money down. He has enough land to build 6 more units on the land. He can use the land as collateral and build it for free and use that to be the down payment to get the money to build the new construction for the 6 units. And he's getting $2,200 a unit. And so being able to build wealth like just that one portfolio can easily, with 4 units in the six, $2,200 a month rent right now, 10 years from now, rent's going to easily be $2,500, $2,600, not more. Now you're talking about bringing in over $20,000 of income. If you just focus on the next 10, 15 years, just paying those assets off with all the cash flow, then now what else do you need? Can you not live off $20,000 of passive income a month if you could just focus on paying those down and you got into the deal with no money out of pocket? That's how you build wealth. Number 18, the law of asset protection. You gotta protect your assets. There's different ways, of course, with LLCs, with the asset protection, but then also trust are a great mechanism to help protect your assets. But make sure you're looking at how to protect everything that you're working hard to build. The law of networking. I can't even talk about networking. Like networking has changed my life. Joining mentorship groups, mastermind groups with other high level investors, other millionaires that's doing deals, that know of lenders and private equity funds that they work with, that we can work with, and other private investors that want to come in on the deals, has changed my life and took me to a whole nother stratosphere that I never even thought about obtaining. But it's just for the networking and being out there and talking with people and being in the right rooms. And 80% of deals come through networking, whether it's with brokers, realtors, the contractors. It's all relationships. You look at all those people, everything right there is all relationships. And that kind of goes right into number 20, the law of mentorship. Like, mentorship and being in these rooms has changed my life, the deals, and it took everything to a whole nother level. And when you start talking about apartment investing, multifamily, it's so many different facets to it. You need more relationships and the right people, and being able to, have people I can call up, have their ear, get wisdom, get some information, make connections happen, has changed my life. But you got to that's where wisdom comes from. The Bible talks about wisdom, and just being able to learn from other people's mistakes. That's wisdom. To take somebody that has 20, 30 years in the game experience, and they can collapse and tell you where to go and how to navigate and how to avoid hiccups, is life changing. Then last, the law of persistence. You gotta take action, guys. At the end of the day, you gotta take action. The work isn't gonna happen by itself. You gotta show up every day, put in the reps, because guess what? Bad tendencies are gonna happen. Bad partners and deals are gonna happen. Market fluctuations are gonna happen. Deals are gonna fall through, but you gotta stick to it, because guess what? That time freedom, The reason why you started all this is super important, is worth the sacrifices. Stay patient, keep learning, and never give up. And guess what? 10 years from now, you're going to be extremely happy with where you are because you put in the work and you didn't quit and you didn't give up. And so that's it. The 21 laws of uh, irrefutable laws of real estate investing. Because the thing is, you got to realize that only you can change your life. And unfortunately, Les Brown said it best that most people won't participate in their own rescue, their own recovery. Don't let that be you. If you are serious about real estate investing, reach out. Go to my website, johnnyliner.com. I have a ton of free resources out there to help you get going, get your first deal done, to look at how you can build your financial plan. We help people put their strategy together for retirement with everything they're doing with their income, expenses, insurance, estate planning. You bring a view of everything with real estate that now you're able to move forward and get deals done. So if you got questions, jump on a consultation call with myself or Coach Jessica with my team. We would love to have a conversation and see how we can help you get to the next level with everything that you're doing, and just keep building wealth, because guess what? We don't have enough time. We're running out of time. We have to take action today. And the thing is, I wish I could do the work for you. I wish I could show up and make it happen, but we all got to get in. We all have those same 24 hours in a day to make it happen. So with that, make sure you guys hit the thumbs up, the subscribe button. I love you guys. Drop in the comments what we can do to help. Tell me what's your best law? Which one resonates with you, and which one do you need to work on going into 2025 and closing out this year to kind of help you hit your goals? And we would love to get that feedback. And as always, if it's something that you want me to cover or dive deep in, share it in the comments, and we'll make sure that I'll put that video together for you. And I'll see you guys on the next video. Let's go and let's make some happy